Good morning, good evening, good afternoon, everybody. Thank you very much for joining. We have a very special presentation today. I think you're going to find a lot of value in. Before we get started, just a couple of housekeeping items. We are encouraging questions. There is a chat box on your desktop that will allow you to ask questions live of John and myself, and we will try to address as many of them as possible live. If there are any questions that we cannot get to during the session, we will absolutely follow up and get you an answer back. But let's get started. Thank you very much for joining me. Today, we are going to be presenting a rich discussion around the role that subscriptions, customer experience, and retention leaders have around customer loyalty, and really, I think, expose a interesting, impactful, and critical view into one of the biggest sources of churn and how to solve it, which in many cases is not terribly well known. So my name is Steve Arentzoff. I am the Senior Vice President of Marketing at FlexPay, and joining me today is my very, very special guest, John Abraham. John is one of the world's foremost experts in customer experience management, building out strategies and effective program design. John spent over 11 years at Medallia, where he co-founded or founded the Medallia Institute, which is where most of the best practices in research and design came from. Prior to Medallia, John was the general manager of Satmetric's Net Promoter Program. He also was in charge of the Net Promoter community and worked very closely with Fred Reichel from Bain & Company, developing the books and some of the best practices, again, and developed and deployed programs from some of the biggest brands in the world. So John, it's an absolute pleasure. John and I used to work together at Medallia, and I'm so excited to have you join us today.
Thanks a lot, Steve. Thanks for inviting me.
Absolutely. So today's agenda, we're going to cover a range of topics, but we want to make this very informative and educational, and also to have you be able to walk away with some direct action items that you can take to quickly start to impact your customer experience programs and the business metrics you're trying to optimize, particularly around customer satisfaction and retention. So we're going to go through now a visibility into declined payments, which is one of the primary causes of subscriber churn. We're going to build the case for why payments should be viewed as a core part of the customer experience. We're going to create an alignment between the organizational structure around where ownership of failed payments should sit and why that should be tied to the retention programs. And then lastly, again, your playbook for how to get started within your organization to start making a quick impact. So let's get started on an introduction to failed payments and why they are so critical and so painful for businesses. So by introduction, when we talk about failed payments, we're primarily talking about credit card transactions. And when we use our cards, we expect them to just work, right? We expect that the banks will recognize transactions that are fraudulent and they'll be declined. But when we use the cards and we want to buy products and services from merchants that want to sell us the products and services, we expect the card to just work and the payment to just be processed. The reality, though, is that banks that issue cards to consumers incur over $30 billion a year in fraud losses, where they're providing positive affirmation or approvals on transactions that were fraudulent, and they have to make good with merchants. So in response to that, what they've done is they have biased their approval processes and systems to look for risks of fraud. And what that's meant is over $400 billion in declined transactions on legitimate purchases, meaning that the customer wants to buy the product or service and the merchant wants to sell it, but the bank has identified that there is a risk, and so they decline the transactions. So this problem that hits the banks, $30 billion, has translated into an enormous problem for the merchant and consumer world. And essentially what's happened is the banks have shifted the liability to the merchant. Now, there's a direct connection between failed payments and churn. And what we mean by that is the places that declined payments hit merchants is different. The banks understand that most of fraud, the bad actors, the companies that are trying to commit fraud, have all gone online. So the approval systems recognize that and decline accordingly. So they look for risk. The transaction types as are submitted for payment are identified. And so the in-person transactions are declined about 1% of the time. This is data that we've gotten from Visa, and from Visa's own data, it tells us that as soon as the the transaction type gets flagged as e-commerce, the decline rate jumps up to 15%. Again, these are the exact same consumers, so their risk profiles have not increased. It's just the way that the banks are valuing the transactions. And then lastly, for recurring payments or payments on subscription services, that average decline rate jumps up to 40%. Now, we also know from Visa that 2/3 of the reasons for failed payments are not because it's a fraud transaction. They're not because there's not sufficient funds to be able to pay for the transaction, but are what we call false declines or inaccurate decisions, decline decisions made on legitimate transactions. And so what this translates to, of course, for recurring customers or recurring businesses is it creates churn. If a failed payment occurs and it's not resolved, the customer is lost. On top of that, what we know from our data, from our proprietary research study, is that 1/4 of subscribers who encounter a failed payment with a merchant wind up canceling their subscription, making the declined payments, both direct and indirectly, the largest single source of churn for subscription companies. So it's incredibly painful for subscription companies, and creating visibility to that really is the first step in solving it.
So maybe I'll make a few comments here, Steve, from my perspective, because when you approached me about this, my background is in customer experience, and I've spent a lot of time over the years working with subscription businesses because the economics in a subscription business make it so that customer loyalty, customer satisfaction, the quality of the experience is really, really well recognized in the subscription world, because when you look at the economics, you've got this really big upfront acquisition cost. It varies by industry, but typically, if you really look at all of the efforts you have to put in between marketing, sales, and onboarding, it costs a lot to acquire the customer, and you don't make back that money in the first year or the first month or whatever the time period is. It takes a while. You need the customer to stay with you to become profitable. So if we look at the basics, what's sitting behind the covers for a financial leader in a subscription business, you've got the acquisition costs up front, and then each year you have revenue coming in that's recurring, assuming the payments work. You also have some costs that are recurring. You have to deliver the service, and those costs change depending on the business. When the customer is highly satisfied, when the experience is great, hopefully, in many companies, you have something you can cross-sell or upsell to them. So you might see over time the revenue goes up. And then the other thing that happens, though, is when something goes really wrong and you have a major problem or an issue or a complaint, it can actually add to your recurring costs. You can have a one-time problem that adds to the cost. So you have this recurring cost at one level, but your cost structure can actually turn more negative if you have an issue. And then there's the question of, well, how long am I going to stay? And the longer they stay, the more profitable they are. So there is an incentive inside subscription businesses to keep the experience consistent and good, so people stay longer, they buy more, and they cost less to serve. And then we make up that acquisition cost, we make more money. It's a great thing. So how does payments fit into all this? We go to the next slide. I was interested, I read your recent research report from 2023, and you asked the subscription companies, the merchants, what they thought was most important to the customer. And there are two things. I mean, you see a whole bunch of things here you had on your list. You can see payments comes in position number 4. But I actually think there were two of these that stood out to me. The very first one I think is quite telling. Companies understand that customer service, having it available when I need it, is super, super important. It's number 1 on the list. There's a lot of other things here about the quality of the product. There's things relating to the experience like easy onboarding, but payments is coming in 4th. So people recognize payments is important, but they think that customer service is the most important thing. And I think there's something interesting about those two. So let's go to the next slide. I want to talk a little bit about how I would look at it from a customer experience lens. So when you and I were prepping for the webinar, Steve, you mentioned that, sometimes in some companies, really the idea of how to handle a failed payment or a decline is something that sits with finance, and it's something that is thought of in a highly transactional way. Well, subscription businesses are not transactional. In fact, these transactions are happening in the context of that lifetime value that we saw before. So when I think about most subscription businesses, what's the customer doing? Let's put the customer's lens on this for a minute. Well, they're doing things like when they have a need in their life, they're trying to decide where they're going to buy it. Then hopefully if they pick your business, they sign up, they get started, they use your product or service, they might make a change, and then maybe someday they cancel. All along the way, what's interesting is two things. First of all, customer service was rated number 1. People can call or text or message or send an email to get help really almost at any point along this journey. And so having that available, this get help experience is something that's connected to many different journeys along the customer's life cycle. And it's terribly important. I'll talk in a minute about why, but if you just think about yourself, when you have a problem with something, when you need help with something, you tend to be really engaged. There's something going on in your life and you need help from the brand, from the merchant. So from a customer experience perspective, it really heightens the emotional attention of the customer when they need help with something. We see payment showing up more than once. First time you pay, of course, when I sign up, I have to set up, but then when you use it on an ongoing basis, you're paying all the time. It's kind of like buying insurance. I pay regularly. And for many people, they think, okay, well, so payment isn't that important. A lot of customer experience people, they think, well, okay, payment, I kind of just want it to work, which is true. Let's go to the next slide. Let's talk about the difference, though, between a payment when it works and a payment when it doesn't work. Because this, I think, is the key from a CX perspective of how you need to understand the payments experience. So there was a professor in the 1980s when the total quality movement was really being developed in Japan. It's a professor named Noriaki Kano who developed something called the Kano model. Some people listening might be familiar with it. It was originally developed in the context of product design, but the basic idea was there are some types of experiences or features of a product or a service that people just expect. So you see them here on the bottom. They're called basic needs. Some people call them hygiene factors. When something goes wrong with that, it can cause the customer to be dissatisfied. But when it works really well or just works consistently, customers don't necessarily notice. And I think payments is like a hygiene factor. I just want my credit card to work. And it's probably not going to differentiate me if the credit card works, because most of the time I expect my credit card to work. Something changes, however, the minute I have to get help, the minute I have a failed payment, et.cetera. My emotional state changes, and how I manage that experience shifts into a different category. So Kano also talked about things called providers, which are kind of like, they're sort of differentiators that can delight you when they're there, but you don't necessarily expect it. Those can be really great for creating an experience or a product that's super differentiated and attractive. However, the third category is the one in the middle, the gray arrow, which when it doesn't go well, you upset the customer. And when it goes well, you can actually build loyalty and the customer can be more satisfied. It can build engagement and loyalty to the brand. And that's very often what we see in customer experience world when we look at customer service experiences. The minute there is a need for help and the customer is highly engaged, how the company handles that, if it goes well, they actually can sort of build loyalty. It's not always the case that when something has gone wrong, it means the customer is going to leave. In fact, if you're really, really good at how you manage that communication, the customer might remember it and say, you know what, this is a company I like to do business with, because when something goes wrong, I can trust them. But if you manage it poorly, now they've had something go wrong, and then you manage it poorly, you can really upset the customer and you can change their perception of the brand. So I think how you deal with a failed payment, it actually sits in this central, what they call performance attributes in the Kano model. If you do great with it, it can really help the business. It can help that equation. And when you have a problem with how you manage it, you might actually really hurt the economics. So if we go to the next slide, I think
actually, John, if I can jump in with one comment on that, I think the case that John is building out for why payments and customer experience are so tightly related is even deeper, because if you think back to the data I showed from Visa, when we follow consumers on how they interacted across different channels, in-store, e-commerce, recurring billing, you saw the decline rates vary so dramatically. So what that means is that the consumer's card is actually most likely getting approved with other merchants, but the brand they're interacting with where the failed payment occurred is where they experience the problem. So they're seeing the card work everywhere else, but not with this one merchant. And what we know from our data is that often the consumer reaction is not to feel like the card is broken, but they blame the brand. My card works everywhere else. Why is it not getting through with you? Which, and as John said, that's it creates very emotional reactions. Like, my card is myself, it's my financial health, and yet you're telling me I can't do business with you. So the ability for the brand to manage that, to reduce that anxiety and that reaction most if possible, but when it does get presented to the consumer, managing that well is extremely important.
Yeah, and if we look at the trends in the market, Steve, the channels, the online e-commerce channel, online subscription, these are ways of doing business that are growing very rapidly. So while what you're saying is particularly true for online merchants, I mean, there aren't a whole lot of merchants anymore that are just retail stores. The vast majority also are doing business online. So I think this kind of Steve asked me, could you give a little reflection, John, on how would you look at payments from a customer experience perspective? And I think the reality is that when there is a problem with a payment, it does become a very important moment of truth in the customer experience for how the customer is going to perceive the overall relationship. And it will then tie into, like we see in your research, whether the customer churns, how they're going to feel. It also impacts the cost, because if you got an issue with a failed payment, that can also probably generate messages to your contact center. So financial leaders should care about it, but CX leaders should care about it too. And I think that is quite different from, of course, you want to design a payment experience so that it's seamless and it doesn't fail. And people probably won't notice when that's what's happening. But you have to recognize that the failed payments are in a category of their own, because they really are a service issue at the same time.
That's absolutely right. And the recognition that the failed payment, in most cases, sometimes there's a problem with the customer's card. Sometimes the card truly has been stolen, or it's a bad transaction, or there's no available credit to complete the transaction. But often it's caused by friction in the payment system. It's not caused by the merchant. It's not caused by the consumer. So it's part of the noise in the system that has to be managed. And but the implications for both the merchant and the consumer are severe, right? If the failed payment occurs and it's not recovered, it's not a transactional problem. It's not a one-time payment that's being lost. It's the entire relationship for that customer that would have naturally occurred. All the revenue they would have delivered over the future billing periods, and now is lost. So the economic cost of that churn is tremendous. And conversely, if you're able to retain that customer, you're able to gain back all the revenue they would have naturally delivered. So the spread on what the cost or benefit is from that one-time event is profound.
Yep. And not to mention the upsell, cross-sell opportunity, because when you keep them, you also have that option value of maybe I could sell them more over time if they're a customer. Yes,
yeah, of course, we know that people also talk, and when they have a bad experience, they're going to share it with their friends.
Yeah, and I didn't even put that into the economics, but it impacts the acquisition cost is what happens, Steve. In fact, that very first part of the economics, the cost of acquiring, when you have positive word of mouth, that cost goes down because you get leads that come in through referral, much cheaper than having to spend a lot of money on marketing. And when you have negative reviews online, when you have negative word of mouth, it gets harder and harder. So it also tends to show up in the acquisition cost.
Absolutely. So let's look into a real world company, one of FlexPay's customers, and really get a sense of what happens when this is done well, and it's really managed across the board. So Alder is a provider of home security services. They protect over 300,000 households. And typical security was monitoring for burglaries, fires, floods, and alerts for medical emergencies within the households and businesses. So because they have a delivery of both service and equipment, they have very heavy upfront costs. John talked about the fact that when you acquire a customer, there is a often substantial payback period just to reach profitability on what it costs to bring them in. In the case of Alder, it's even more substantial because they do spend money on equipment and the installation for that service. So their entire mandate is around what can we do to improve retention, and what can we do to increase the lifetime value of the customers. And they were experiencing failed payments. And so they came to FlexPay. We were able to help them, got them launched. And we have two solutions. We have our AI-powered invisible recovery, which works directly with the payment system to recover failed payments. And the benefit of this system is that because the problem can be resolved in many cases without the customer being aware of it, there's no impact on retention, there's no impact on customer satisfaction. We use the term, if we can actually resolve the problem without the customer knowing about it, in the customer's mind, the problem never occurred, which is it's just going to be best.
Well, there's one more thing, if I can add, Steve, and when you explain that piece of it, if we look at it through the customer experience lens, the other big advantage is the customer doesn't have to call or email or complain, or right. So those costs I talked about before, you can also avoid some of those costs if you can resolve it behind the scenes with the right technology, instead of having to engage and put time in customer service and emails back and forth or messages with the customer.
That's 100% correct. In fact, with Alder, what they told us was that after they rolled us out, the amount of effort their customer support team had to drive an outreach to customers trying to manage the payments that failed, as well as the inbound call volume went down dramatically. They were actually able to repurpose people away from that process and put them on other uses that were more tied towards the traditional customer retention and satisfaction programs. So I had a very direct impact on cost reduction as well as revenue generation. And we also were able to employ our Engage Recovery product, which uses behavioral science. So we always want to try to resolve the problem if the customer is not aware of it. But when we do have to engage, creating a very positive collaboration with that customer, working with them to resolve the problem, making sure we're not blaming the customer who didn't cause it. In most cases, it was really able to move the needle for them. So for Alder, their ultimate outcome was that they've been able to reduce their customer churn over 50% that were caused by failed payments. And their monthly rebill rate, the way they view their month over month retention of customers, went up from about 48% to almost 80%. So very, very strong improvements and very tangible results, leading directly to revenue and profitability growth. And because the revenue from current customers is not having to incur the cost of revenue from new customer acquisition, these dollars that are coming from retained customers tend to be the most profitable dollars for the business. So Alder was able to see that not only was their top line revenue increasing, but their bottom line profit growth actually was accelerating because of the retention that was being created. So very powerful, very quick results for that business. And that's why, as John laid out, one of the themes that we want everybody to understand is that when the payments process works, it just works. Everybody expects it to work. Everybody expects their payments just to go through on a monthly basis. But as soon as it fails, that does create, in most cases, a customer support issue. Whether you're going to talk to the customer or resolve the problem independently of the customer, recognizing that this is a customer experience that should be consciously designed becomes really important to understand. Many companies have recognized the failed payment problem, but often the recognition for that is occurring within the operations team or technology, the technology team that owns the payment stack, or even in finance, because finance sees the payments being rejected and drives initiatives to try to solve it. But unfortunately, the viewing of that typically is also viewed as an operational or back office problem, where the solutions put in place will chip away at the problem or use tactics that will not necessarily optimize around the customer experience, because the CX is so retained, not just to resolving the problem, but also retaining the customer as long as possible after the problem occurs. It's not necessarily driving the best outcome. So what we recommend is that when you think about designing a CX strategy for payments, look at the failed payment and work as much as possible directly with the payment system. We want to solve the problem. We want to avoid the customer ever becoming aware of the problem. That also has a side benefit. If the payment issue can be resolved quickly, typically within a couple of days, that you don't have to interrupt the service or product delivery. So again, the customer is never made aware of the problem as far as they're concerned. They're to continue to access their service or get access to the product delivery, and they're happy. In those cases, though, and there are going to be some where that direct resolution is not going to be successful, that you do have to interact with your customers to be able to solve the problem. curating a very crafted and designed program to create this positive experience and engage with your customers becomes absolutely crucial. Again, as John alluded to in the past, a couple minutes, there is a way to be able to deliver experience for your customers where they walk away actually more satisfied, where they actually appreciate the help, you're helping them resolve a problem that's interrupting their access to what they're trying to gain from you. And so designing that experience to be proactive and positive is key to not only solving the problem, but also retaining the customer.
Yeah. So, to wrap up, you mentioned it'd be nice to leave people with a bit of a playbook. So Steve and I worked collaboratively on this sort of summary list for those of you listening in. And I'm assuming you guys will share the recording or the slides with the attendees, right, Steve?
Absolutely.
So, and some of this we've already covered, so think of this as a bit of a recap, but I just want to say a couple notes about the first item. So there's one other topic from a CX perspective that sometimes comes up, which is if you look historically, for example, in the credit card business, there were certain types of customers that marketing was going after to meet their numbers. And they were customers who didn't stay very long, customers that would come in because of a special reduced interest rate offer or something like that. And when you looked at their long-term economics, these were switchers. They would switch, marketing gets their bonus for bringing them in, but then from a lifetime value perspective, not so profitable. So if you get into a conversation about, okay, I have failed payments, but are all these customers created equal? Do they all meet our right target profile? Like, maybe that's something you want to look at before you dive straight in, especially if you run into any skeptics who say, hey, why would we invest more in trying to improve the payment experience? It could be that what they're seeing is they're seeing a subset of customers who are not profitable, even if you try to address things. They're costly to serve, et cetera. I think that tends to be the minority, but just as part of a playbook, I think it's just good hygiene to say, first of all, think about customer segmentation before you dive in. And you might actually have an issue with who you're targeting on the marketing side of the house, which is separate from whether you should invest in fixing the payment experience. Because for the majority of people coming into your funnel, you're going to want to retain them. And probably most people in the business will understand that. Second thing is understand that when the payment is declined, this becomes a pretty critical moment for how are you going to design that and manage that from a CX perspective. Wherever the ownership sits within your organization, you should try to think about it and approach it as a customer experience challenge. Even if you have somebody saying, look, I got a customer who we just have insufficient funds. They're not paying. I had a customer years ago that I worked with, a company I worked with that actually served a target segment, which were low income people who sometimes they struggled paycheck to paycheck. They knew that's who they were selling to. They leased stuff to these people and they understood their interest rate was higher because these were higher risk customers. But in fact, they were profitable. They just were more likely to miss payment. And so they spent a lot of time thinking about how they're going to design the process around following up with the customer when a payment is missed. Because the key thing for them is the customer wants to keep paying. They just run into problems. So you can build that into your business model. How you design that experience is very important. And then, as Steve said a moment ago, step 3 is try to find ways to solve it without bringing the customer in. That will save on cost, but it will also keep the customer happier. And honestly, in some subscription businesses, the minute the customer has an issue like this, they might just leave the subscription running until there's an interruption. It actually gives them a reason to think about, do I really want to continue or do I want to cancel or switch? You don't necessarily want to cause that to happen. Once they're on board, you really want to make it seamless. And then finally, if there is an issue, again, design around that and try to make the experience as positive as possible. And be careful within the business. Understand that customers want to pay, even if they have issues with paying. And in fact, the customer is often embarrassed. Think about whenever you have a failed payment yourself, it's an emotional time. So how you address them, how that service experience feels, do you treat them with respect? Do you assume the best that they want to pay and try to help them figure out a way to pay? I think is great. And Steve, you mentioned simple things you guys do, like thinking about the time of the month when the recurring payment should occur. working with the customer in that way. I mean, those types of things can be really, really helpful. So I think with that, it's time to wrap. Do we have time for any questions, or how are we doing?
Yeah, we do. We do have a couple minutes. John and I will stay online as long as anybody has questions. I do see one in the chat. Feel free to add them if you have any questions of either John or myself. The question I have from Joyce is, and I'm going to paraphrase here. So it seems like when the CX leader thinks about failed payments, it really involves a combination of systems and technology as well as processes and experience design. Is that correct? I can start that. And I think you can also chime in with an answer. I think that's absolutely correct. The technology that's available often is viewed first by your operations team and finance and technology. But our recommendation is that because failed payments is often one of the larger sources of churn, which we know is a metric that the CX leader is tasked with solving and reducing, creating the partnership with those teams so that there is the best in class technology and operations to be able to deal with the problem, but that the way that the experiences are being crafted is aligned around customer sat and retention. And that's absolutely where the CX leader plays a role.
Yeah. Yeah, and I agree with you. The only other thing I would add is, that is a long list of things, right? How you design something, the business process, the technology, and that is the world of customer experience. Is customer experience, when you have a failure, it can be caused by any of those things. And Steve and I previously worked at a company called Medallia, and one of the core things Medallia did is that they got data from customers about their experience after the fact to try to understand what should a company prioritize, what are people saying when they give feedback. The other thing you can do is you can look directly at what is happening when the failures occur and people are contacting the contact center. What are the underlying root causes? Which is, I mentioned the Kano model before. That's from the total quality movement. The idea of root cause and identifying root cause dates all the way back to the total quality movement. So knowing whether you need to work on business process or whether the issue is you have technology that's behind the times. It could even just be maybe you have some of these pieces in place, but your service people are not really using the right soft skills when they're dealing with someone who's had a failed payment. You really need to understand what's going on behind the scenes to know where to focus.
That's a really complete answer, John. Thank you. So I don't see more questions. I think John and I can stay online a few more minutes. But in close, I want to thank you for joining us. It was, I think, a wonderful conversation. John, thank you very much for contributing your knowledge to us and to the audience. Just as an introduction, FlexPay is a provider of failed payment recovery that is able to work directly with the payment system in many cases and create very carefully crafted experiences that are powered by behavioral science, all aimed at both recovery and retention. And if anybody's interested in learning more about what we can do for you to help reduce your churn, to solve your customer failed payments problems, reduce some inbound costs to your call centers, please go ahead and just shoot us a note, and we'll be happy to have a conversation and introduce that to you. Thank you so much for joining us today.
Thanks for having me, Steve.